Hello everyone, it's me the Boss Dog with a video on my portfolio as of the week ending and the year ending the 30th of December. Lots to go through this week. We've got some buys, we've got some sells, and we've got some company updates. Let's do it. Alright, so if I'm honest, a fairly disappointing end to the year. I was hoping for a bit of a Santa rally just for the purely nice feeling that I would have had if I was able to finish the year in the green. However, honestly, I feel kind of okay. Like I still am confident in my positions. I'm down just over 1%. But in the scheme of things, considering the year that just was, I feel like the portfolio held up reasonably well, and I continue to comfortably outperform the S&P 500. Although I have fallen back again against the FTSE 350, mainly just because the FTSE 100 has so many sort of mining and defensive companies. So that's the FTSE 100 has basically outperformed all of its competitors for the last year, and so there is that. But broadly, again, I remain confident in my long-term nature of my portfolio, which is quite heavy on the tech. And again, considering the fact my portfolio is 37% tech, could even be as high as about 42% if you include some of the ETFs, which are very tech dominant, then I'm actually really happy with that performance. So although it was disappointing not to finish the year in the green, the fact is I remain just modestly red, and by now I've kind of got quite used to the bloodshed, as long as it's not a really big bloodshed, but -1% just doesn't feel too bad to me. I have got around to adding again, so I put in 4K in two 2K chunks, both into my wife's ISA there ever. So when you look at the table there on the sort of top right, although it shows that the change week on week was plus 3.568, really you have to bear in mind that that's with a 4K deposit. So it's more accurate to talk about that being -432. So just to sort of give you that overview there, because I think that's actually the first capital I deposited since I started showing that, so we need to bear that in mind moving forward. In terms of dividends, there's a modest catch up since the 19th of December. I got almost all of my dividends for the month with the exception of Huntsman Corporation, which to be honest with you I wasn't really expecting in December anyway. I was kind of quite happy to get T-Row because that's the 29th, so that came through in time. And Huntsman, I had it last year as well, so I had the dividend in January, which is when I recorded it. If you assume that my Huntsman dividend is actually a December one, then my dividend across the whole of December would have been just under 200. And broadly speaking, my run rate at the moment is about £250 per month into my investments. So it's about just under a 3% yield effectively. But where half of my positions are in the UK, a lot of UK companies pay what's called a final and interim dividend, and they'll pay twice a year. So it's not like you're seeing a gradual £250 a quarter or something like that. It's going to be very chunky moving forward, where I have very big dividends in kind of the April to June period and then the September, October, because that will be both the quarterly from the US as well as the twice a year from the UK. But my average now should be about £250 a month, all things considered. There was quite a big delta this week actually between Google and Trading 212. So just as a reminder there, that's the portfolio that I use on Google Documents to bring together the 3 accounts that I have. Normally it's pretty close, but it was like £400 out this week. So, if I look on Trading 212, it tells me that I was down 432 this week. But if I look at Google, it says 812. Now, I must admit, over the last 2 weeks, the Google database that's used for share prices has been really sketchy and unreliable. So, to be honest with you, I think it's kind of a combination of maybe they're doing some festive maintenance, or maybe, with like some closures on the FX side as well as the stock market. There's just been a bit of a disconnect. So ultimately, actually, what's more important is really what's in Trading 212, right? That's real. And the Google Documents is just for my admin. But this is the highest it's been. So I'm kind of expecting this to fall back down toward parity moving forward. Obviously, I'll keep an eye on it just to make sure there's no real problems. But again, I think it's important that I call that out and continue to monitor this moving forward. Anyway, like I say, I have been quite active this week because of the fact I both bought and sold. So let's have a look at those things now as well. Alright, so I'm actually going to start with what I sold first of all. Now, for anyone who's new to my channel, because my wife works in private equity, I'm actually quite restricted on what I can do with individual shares, which includes selling. So I basically have to get permission from my wife's employer, and they presumably have some kind of clearance with the SEC before I can sell. But basically, I just email them, and within a day, typically, I get confirmation I can sell, and I just have to confirm I have no inside information or anything like that. So that was kind of fun. So in terms of EPD here, I was essentially forced to sell my position, and this is my 3rd time I've been in EPD, and this is my smallest one really. It's a bit sad, but basically my brokerage no longer wants to support it following an IRS tax change that's due to go live in 2023. So we were more or less forcibly told to sell, or they would sell it for us. So I was a bit disappointed by that, but fine. I decided to kind of try and get a couple of weeks ahead on everyone else, and basically redeploy it into. You'll see in a second. So it's a bit sad because, like I said, I like EPD. I prefer pipelines to things like telecoms infrastructure, just because I think it requires a lot less capital investment moving forward. And EPD as a UK investor was really attractive because I didn't have a dividend withholding tax. So with most of my US exposure, I have to pay 15% tax before it comes into my ISA, or I pay it to the IRS. So it's not, although my ISA is a tax efficient wrapper, it gets taxed before it comes into that wrapper. Whereas with EPD, because it was giving me distributions and it was, an MLP as a company, I didn't have that 15% deduction, so it was attractive from that perspective as well. Plus, I just think it was a very conservative and sort of solid company that you'd want exposure to. So, all things said, like I say, I'm sad to see this go that I was kind of forced to do it, but I'm not too sad because I made good money on this over the couple of years that I've had it on and off. And yeah, that 940 there, that's my total profit and dividend across that time period. So obviously a very green position, all things considered, but we won't be having it anymore moving forward. The Alliance one here was particularly annoying because there was like some kind of rounding issue with my brokerage. So they basically forced me to sell one of my shares that I then subsequently bought back at like a penny less. So yeah, I needed to include that basically just so my kind of Google tracker and everything else matches, as well as again like full transparency. So that's just kind of an admin thing that my brokerage was doing, where previous buy was 1p more expensive, which then meant that this went through and put my account as minus 1p, and then it forced me to sell one of my shares in that ATT. So all right, fine, that's what happened. But the EPD here is the big one, and let's see what I used that resale for. As well as my new capital and some dividends as well, right? So let's do that now. All right, so broadly speaking, this is where I've put my money basically. This 4588 here is basically 4K new capital, then my EPD, 500, and then the difference is the dividends that I got from the initial introduction, right? So I've grouped these into four categories effectively. So AAT, XDWH, TR, ET, and HCAN here. These are like all my ETFs, or about half my ETFs, but the ones that are in my wife's ISA. Now, XDWH here is actually a new position for me, and I think next week I'll actually break down the holdings that it has. Basically, I would summarize it by saying that it is a mature healthcare ETF. That's how I would describe it. Since I sold out of Bristol Myers, I've had basically no exposure to healthcare, and so it's a clear gap that I had in my portfolio that I'm keen to build into. I bought BNY and made some good money on it, although probably sold too early, because to me it was just very clearly undervalued. But if I'm very honest, like healthcare isn't really an area of expertise for me. I remember trying to read through like a 100-page pack that BNY produced, and it was very difficult, right? Like I was trying to look at some graphs and some drug pipelines, and it just wasn't very easy for me to get my head around. So I'm very excited actually to have this ETF that I found and that I was able to buy. I opened reasonably with a commitment of 1,000, which I would say is a fair commitment for that. I probably would have made it even more, but I was keen again to increase my exposure in ATT. I think it is clearly undervalued compared to its net asset value, and it's been a bit beaten up, not least because it had a top 10 exposure to Tesla. But still, I still kind of have long-term confidence in technology, and for me, it's a great opportunity to be increasing my position in ATT. So again, that's the reason why I kind of put more in that direction rather than my healthcare. But still, I'm looking forward to that as well. Then I've got my REIT ETF, which is TRET, and I've got HCAN, which is basically an ETF to Canada, which to me, I'm kind of bullish on the long-term macroeconomic situation in Canada. I know it's not the most exciting stock market in the world, perhaps, but it's got it's good for me to get that exposure, and because again, I back the country in the long term, I think it's perfectly fine to have the exposure there as well. So that's where my new capital went, basically the $4,000. Then we've got here a couple of my ETFs in my ISA, which is where EPD was, and I basically just split this into three, but not quite equally. So I put 100 into my digital security and clean energy. I had slightly bigger positions in them already, and then I put the better part of 300 into the robotics. And what that does is it brings them up to a very similar point. They're about 0.9% each of my portfolio. And again, I want to get them to about 1.5 to 2% of my portfolio in the medium term. So they're just all moving in the right direction, basically. They're all down about 5% at the moment. But again, considering the market and what those ETFs are, I'm perfectly fine with that. And I'm fine buying into red. Then I basically reinvested my dividends from companies that I believe in. Amcor especially is kind of, depending on the exact price, is my largest stock, or clearly one of my top three, with that, Gamma, and Games Workshop. So I'm very bullish on Amcor, even though it's had a bit of a fallback following the run up it had after its results. T. Rowe likewise, obviously that's impacted at the moment with the wider stock market, but I'm very happy buying T. Rowe at these prices. And similar to Microsoft, I think Microsoft's an absolute beast of a company, so I'm using any opportunity I can to buy additional positions in these companies. And again, because of my wife's employment in private equity, I can't use my capital adds to buy singular companies. So basically, dividend reinvesting is the only time I can buy companies that I basically grandfathered in when she joined. So for me, it makes a ton of sense to basically add. I mean, Amcor, I'm still up like 25% even after the fallback. I think actually it's close to 30, but to me, Amcor is still very clearly undervalued. So I'm more than happy to buy Amcor in the mid 20s, frankly. The other two I am red. T. Rowe quite significantly, sort of just over 10%. Microsoft just by a couple of percent, but it's again absolutely fine because the companies are almost paying me to average down. And again, with Amcor, it's not the same situation, but I'm happy to increase my position with them. And then with SMT here, so I've covered SMT before. This isn't a particularly big addition this week. I have been adding this. SMT is closing in on about 2% of my portfolio, and I would like to nudge it up a little bit more just since I became a bit more familiar with the fund, because 30% of its positions are private companies, and it just gives me a lot of exposure to kind of more of the high risk, high reward parts. Where I don't have an opportunity to buy them otherwise, basically. So SMT, like, you regularly read about it, and it's like, they talk about its exposure to NASDAQ and everything else, it's very tech heavy, and I guess in a way it kind of is, but it's actually a really simplistic overview of that fund, in my opinion. And so I don't actually consider SMT a tech fund, which might be a bit strange to a lot of people who haven't like delved into it. It's a lot more than that. And again, I covered this in a video a few months back. And I will be looking again at it in sort of a few months just to do sort of a round two, see how it's changed over time and how it's performing. Right now, it is very beaten up. A lot of the companies it invest in are early stage and highly volatile. But again, I'm confident that it will continue its overperformance in bull markets. Basically, that's my position here. So it's a good chance for me to average down. I'm down about 17–18% on my SMT position at the moment. So it's a good opportunity for me to average down anytime I can. And I would just say with Kainos, although I still believe in it, I think it's not too far away from its fair value, probably less, maybe 10% under, but not too much in the kind of wider market. So whereas Amcor, I believe at the moment is close to 50% undervalued, I think it should be in the mid 30s. For Kainos, it's kind of, probably in the high 16s would feel reasonable to me. And so I just thought it was a slightly different situation to Amcor, and I'd rather use my Kainos dividend for SMT rather than reinvesting in Kainos. So that was my thinking there in terms of that. Anyway, let's have a look at the breakdown of my portfolio as it stands. All right, so this is looking a little bit different because I've added in the 3 months. I'm going to revisit how this looks and what periods of time I choose to show. I think it's a bit busy at the moment following the 3 months, but I also think it's interesting to see that over time. So I have now included the 3 months, but I realize there's a slight issue, and the issue really stands out when you look at SMT there, so Scottish Mortgage Investment, which is about a third of the way up from the bottom. And you can see it's up 108% across a 3 month period, but that's because that's also including additional capital that I've added to it. And I realized that like the trading column there, that includes my weekly buys, which is a good way of stripping out my weekly buys against the weekly movements, right, of my position. So that works, but I'm not doing the same for either 4 weeks or 3 months. And I think it only became noticeable to me for this time because I added so much capital that it kind of skewed it a little bit. So I need to have a little bit of a rethink about how I present my data in the trading lookup that I basically do in order to facilitate that week on week change. But I also think that right now, like with showing the previous weeks and everything else, it's just a bit busy. So bear with me a week or two whilst I get on top of this. But anyway, it's as factual as I can make it, especially the week on week stuff is purely accurate. You can see actually that a lot of my smaller companies had a pretty good week, which was kind of interesting. Crichton's not least among them, although that's kind of quite an illiquid and fairly volatile small stock, very small penny stake, penny position. But yeah, there wasn't a bunch of huge movements, I would say. Overall, the fact that my portfolio moved less than 1% over a couple of weeks. But Genius continues to be quite beaten up, I would say. I think it's fallen back much too far now. If I was buying individual companies again, I would absolutely consider buying at these kind of levels. Obviously, it's not financial advice, but that's just my opinion. Amcor likewise continues to also be pulled back, as you can see it there as well. We're like grouped with the semiconductors. For me, I remain optimistic about semiconductors, but I would say I think a lot of this was caused by Micron's quite dreadful actually quarterly update. Like my position with Micron is kind of similar to like Redrow and house builders, which might seem a strange connection to make, but by that I mean like everyone kind of appreciates that they're about to have a difficult period of business, but they're so beaten up that to me, like even if their projections halve or more, it doesn't exactly make the stocks look expensive. So again, like Micron would be another position I would be buying. ASML to me is like such a high quality company that although it still looks quite expensive, I don't think you're ever going to get it on the cheap because of what it is and who it is and what it does. So I think like Amcor has actually been pulled back because actually its last quarterly results were incredible. And unless Amcor really has a huge reversal, I don't expect it to be pulled down in the same way. It's much less cyclical because of the type of semiconductor it is with like the packaging and the testing. It's just a little bit different. So it's less cyclical, though I do expect it to be impacted. Everything else there I think is kind of partly sentiment driven. And actually, like I say, I would consider the last couple of weeks to be just down sort of £800, or indeed £400, right? If you look at my trading 212 accounts. So less than 0.5% from that perspective is really positive. And yeah, I think it's been helped recently a lot by a couple of big bits of news. Hollywood Bowl absolutely smashed their results. Games Workshop likewise with the Amazon tie-up. And actually until the Amcor pullback somewhat, Amcor has also been a big winner for me over the last sort of few months, despite the pullback over the last few weeks. It's still a fairly sizable win, all things considered. So yeah, I've got EPD highlighted here. They'll fall off next week now that they're fully left as a position, and we'll update XDWH, so my new healthcare position moving forward. Obviously, at the moment, I don't have 4 weeks or 3 months to compare it against, and that will gradually drift out over time, as indeed Alliance Technology Trust. You can see the 3 months there isn't yet valid because I've had it for less than 3 months. So again, I'll revisit how I present this. I think I could do it a little bit better, and the fact is that because of the trading volumes on my 3 months is really wrong. So I need to think about how I do that and what it looks like. So bear with me. But anyway, I'm going to have a look at the top 10 companies that I like to walk through now. All right, so these are the companies of interest that I want to specialize in terms of my knowledge. I've again attempted to order this by the order that I think is most important. So we're going to start with Phoenix here. So 2 points. First of all, they extended their partnership with Samaritans. You can more or less think of that as like a sponsorship. But because Samaritans is a charity, it works a little bit differently. But basically, it means that they put their name on it. It's a bit of PR, etc., etc. So for me, I think Samaritans is a good charity. Actually, for anyone who's not familiar with it, it's basically if you're feeling down / suicidal, you can call them and just talk to somebody. So that's I think a well-intentioned charity, and I have no problem at all with Phoenix partnering. It's only 200 grand a year, so it's modest by Phoenix standards, I would say. The more exciting part, not to say the other part isn't exciting, it's just a little bit different, but the certainly more material impact is the £15 million investment that Phoenix announced into MoneyHub. Now, MoneyHub, a lot of people I suspect won't be familiar with. What it really is basically open data architecture from a fintech perspective. So open banking is what I'm more familiar with the term. It has been a bit of a buzzword for several years, and kind of the infrastructure is only just kind of catching up with the expectation and hype, I suppose, which I guess is fairly standard with this kind of stuff. But it's really about kind of having plugins between different financial offerings. I think the main incentive in the insurance industry at the moment is that by August 2023, you basically have to be able to provide a pension dashboard, and this was announced by the government a couple of years ago, and basically they gave the industry a couple of years to get their act together. And for anyone in the UK, of course, you'll know that you sort of have workplace pensions, but because many people move between jobs, etc., there's now this requirement to basically pull those pension pots together and present it into a single dashboard. Um, but you know, the industry is sort of under time pressure, shall we say, from this, and I think Money Hub is well positioned to kind of benefit. Now, Phoenix kind of joins existing investors as a minority position, so it put in 15 million from a fundraising of 55. 35 was raised by Legal & General and Lloyds, which were the existing primary owners, and there's another 5 million from a banking company as well that's not too related, but basically is providing funding for that. And I would say also that Phoenix had a relationship already with this company through their a wellness proposition, as they call it, called Money Mindset. But really, it's just kind of, again, customizing pension management. So I think this makes a tons of sense to me, both to kind of solidify that relationship. Money Hub has 100 customers, so it's, again, not exactly a small company, but also not big either, right? So, and also it makes a lot of sense for me to Phoenix to both strengthen that commercial relationship as well as kind of understand a little bit better that technology and potentially, you know, move toward further ownership as we progress. I can see good reasons also why Legal & General and Lloyds are in this as well. To me, it makes a lot of sense. And it'll be interesting to see what happens with Money Hub in the future as well. So, but for me, I think it's a sensible, not exactly a huge sum investment. You know, I mean, Phoenix has got like 1.5 billion in cash, so this is a tiny investment. But again, it's a smart strategic investment, I think. And I do expect it to increase over time, right? If Money Hub grows, there'll potentially be further fund rounds, and then Phoenix will be expected to contribute more. But right now, for me, it's cool to read, and yeah, some good news. Next up, also good news, I would say, is that Gamma is one of 10 companies approved from the UK government framework. So the word framework for me in this industry, and again, I'm in the telco industry, so same as Gamma, this is a super common thing that the government likes doing for just about everything. It basically has frameworks for, you know, healthcare, local councils, and what you do as a supplier is you basically get on the framework agreement, and that allows you to then sort of basically submit tenders to go into business to provide. If you're not on the framework agreement, you just can't provide. You don't have an opportunity to, basically. So this is, I think, a 10-year framework. Gamma was already on it, to be clear. So this is a renewal of that. It kind of joins other telco companies like BT and Virgin Media, the other two big ones in that, as well as sort of some infrastructure companies that, you know, you won't have heard of, and it doesn't matter too much. But it really just shows kind of Gamma continuing to add value and sort of punch above its weight, I would say. So that was good for me just to have that announced, and potentially it will mean that Gamma will be able to increase their business. I did try and get hold of commercials in terms of like what Gamma expects this to be, but I wasn't able to. I will continue to kind of probe on that. I don't expect it to be a particularly massive part of their business, but I do expect it to bring sort of 8 figures over several years, so a couple of tens of millions over the length of the framework. So I guess that's kind of the position I would expect it to be at, but I haven't actually got that confirmed yet. But if I am able to find out and I can share it, then I will do. So Hollywood Bowl here, I didn't have any new news per se, but actually when I was reviewing stuff, I realized that I'd actually missed an announcement from October, so sorry about the delay. But basically here they announced the final dividend, which will be payable next year in February, of 8.53p, and therefore the full year dividend of 11.53. This was actually really good. Like when they had their trading announcement in September, they announced that they expected their dividend to be at least 7.5. That was what they were expecting at the time. And to be honest with you, I felt like that was a bit conservative, and I wanted it to be at least 8. And I wish I'd actually added it to the video. So that I mentioned in the video. And in my head, but I didn't mention it in the video, I was like, I think they should actually go for like 8.5. Like when you actually look at the way that Hollywood Bowl does its payout ratio, it looks to pay out 50% of its profit. That's what it's done historically. And although they haven't yet committed to doing that moving forward, they have sort of said that they want to be reverting back to their previous dividend policy, which therefore I expect to mean that, you know, in the next year or two, assuming there isn't a kind of resurgence of anything, that's what they'll kind of commit to. So effectively here, their dividend growth and their earnings growth are going to be running in parallel for the foreseeable future. That's how I would position this. And because of the fact that I expected the earnings to be a bit higher than the industry was expecting, I expected it to be in the 8s. And then when they produced their numbers, of course, they were even better than I was expecting. So, you know, the 8.53p here is a good win. And for me, like when you look at the share price, even after it had a little bit of a run up following the details of the results that were published, it's now like yielding sort of a 5% yield on a growth company. And I just think that's fantastic. Again, I think it's like a real sleeper. This is a penny stock. It's £400 million market cap, but it's a really solid business. So that's very exciting to me. And yeah, I just felt like it was worth mentioning that I expect that to continue moving forward. Genius had some positive news that it just gained another gaming license. Now it is its 39th, so I suppose it's not like a kind of bells and whistles thing, but Ohio is considered one of the big prizes in America, so this was worth highlighting, I suppose. There was also a positive review sort of following up on the Caesars Genius NFL tie-up, so that's cool as well. And also there was a reduction in the short position, although it still is quite elevated, I would say. And again, the stock price remains quite beaten up. So I'm kind of reading the news in Genius, and maybe I have my own bias here, but I am sort of hoping for a turnaround in fortune, but we will see how that shakes out. In terms of Everaz, you might recall a few weeks ago that they were basically, they had to suspend a vote that they were required to run about some notes that were due to be repaid in 2023. Effectively, as a result of that postponement, they went back, presumably checked legal things, and basically announced that they would be doing this anyway. There was a vote, but again, it was like, you know, they were ticking boxes from a kind of corporate governance perspective, which I suppose in a good way, I shouldn't diminish that. The fact is the company still is trying to run itself as sensibly as it can do. And so that's fine. And again, to be clear, Everaz maintains that it still expects to pay this, but they're not entirely sure when they'll be allowed to, right? Again, they can't pay out dollar amounts. The Russian state just isn't allowing it. And they're basically arguing that they need the financial flexibility anyway. So it'll be interesting to see what happens with this in the next few years. But for now, they have officially announced that they will not be paying the bondholders of those notes next year when it was due to full owed. So yeah, an update on that. In terms of medical properties, so they did have a little bit of a jump following news that Steward, which is its largest tenant, had secured, basically renewed its line of credit with its lenders. There is a bearish argument that basically says that Steward is a basket case and it's in deep financial trouble. Steward is a private company who has no obligations to publish the numbers. MPW about 6 months ago did publish where their tenants were willing to share financial information. They did actually put it into a quarterly update, but it was like, it didn't really do them any good. Everyone not because they were bad per se, but they were just like, they just seemed to like cause more questions. I thought the update was both more transparent than was technically required, but it didn't really facilitate any change in sort of feelings. But this renewal basically did improve feelings somewhat. And I would also say that Steward's contribution is gradually reducing in terms of its importance to MPW, but it still represents over a quarter of its customer basically. So it is still a very large customer. So I get where that's come from. I would also add that there were multiple articles over the last couple of weeks about this company, both positive and negative. But it didn't really change anything or add anything to the discussion. So the only thing really that changed the needle was this announcement. And for me, like when I look at the bear cases of MPW, I would say that they are broadly divided into three, which is basically Steward. I'm just going to summarize it as Steward. Secondly, is the fact that MPW are taking commercial relationships beyond being a tenant and landlord relationship. So they'll, for example, have like, you know, loans, or they'll take equity stakes in the company, or etc. So this is not an immaterial part of their business, but not a majority of it either. To me, actually, other niche REITs do have similar-ish kind of commercial agreements as well. It's very different to how something like Realty will be run, where it's like a general all-purpose REIT. This is a niche, and so I have no problem if they're able to find a commercial opportunity that they can then deliver on. So that's the second issue, which for me is a non-issue. And thirdly, the other bear argument, as I would summarize it, is that in some way MPW isn't accounting for the value of its assets in an accurate way, which again, I just don't really think is fair. Not because I'm like particularly knowledgeable about asset accounting, although by the way, I do have accounting qualifications, so I'm not an idiot about it either, but I can't find any obvious anomaly. And for me, the other issue here is that when, you know, bad things do happen and the tenants, either a single hospital or a whole group, go bust, MPW have demonstrably shown over many years that basically their numbers are correct. They come in more or less in line with their expectations, and actually they've been able to make a small profit, you know, kind of like 70 million. So I say small, but to the size of the business, it's not huge. But the fact is that I have reasonable confidence in the value of the assets as they calculate it. and confidence that if anything bad does happen to either a whole company or an individual hospital, that MPW have the assets that are needed, and they'll basically be able to find tenants again. So I wouldn't say the bear positions are particularly changed, other than Stewart here extending the line of credit, which was sort of seen as validation of the fact that the company can't be that bad if banks are willing to continue to lend the money, right? Next up, we've got Kainos. Just a couple of updates here, really. But there was a non-exec buy of 100k in terms of share value. I wouldn't say that's a particularly big buy. And also, Kainos insiders own around a quarter of the business, which is more significant, I would say. Again, this is a very small, and not even that small anymore, a very young company. And they've grown quite rapidly to the point that, they did have a lot of sort of stock compensation, etc. in the past. That is winding down quite rapidly. But again, I expect this company to continue to have a lot of inside ownership because of the nature of the company. Basically, it's like a software company in the early stages of its growth. So I don't mind this so much. The important thing to me is about basically the EPS, and that's moving in a really positive direction. So that's fine. Amcor here. So there was a Simply Wall Street article that highlighted the return on capital employed, as well as the outperformance against the wider semiconductor industry over the last 1 and 5 years. So that's great. I would also say it's very positive about the fact it has a tiny payout ratio, which is something I've spoken about before. So even though they increased their dividend by 50% in the last quarter, it still only pays out like 7% of its profits into dividends, which for me, again, I'm not really buying Amcor for the money today. This to me is a growth and dividend growth future. And I'm more than happy for it to be reinvesting its profits into itself at this moment in time. So that's good. There will be some disruption over the next year as their new site in Thailand goes live, as well as sort of, again, a wider impact of the semiconductor space. But I do expect them to continue to be strong and actually continue to outperform whatever the wider semiconductor industry looks like. The article did flag the fact that they expect earnings growth to reduce by a couple of percent over the next 3 years. So it's plausible that the company will tread water, but I think actually that will only be a surface level, a treading water surface level detail. I think actually underneath the surface there'll be considerable work ongoing within Amcor. So that's fine. And just to wrap up here, just a couple of Games Workshop. So the Warhammer Tacticus, mobile game, it won the mobile game of the year, so I think that's good. Again, a lot of future optimism around Games Workshop is specifically focused on how they can leverage their IP and royalties. Again, I actually think that's a bit harsh on the core business, which is still an incredibly financially powerful business. It's so efficient, it's incredible. So actually, I think a lot of people are kind of sleeping on just how good the core business remains. But on top of that, then you have the hope of the IP, not least the fact with the Amazon tie-up, which kind of is an extension of that. It will be very interesting to see what happens with Warhammer Plus now that they have that tie-up. There's a lot of theories floating around at the moment about like whether Games Workshop were not really wanting to invest that much in Warhammer Plus, which is their streaming service, if they were just going to be putting something through Amazon. So that would also be interesting. I was curious about it myself with the announcement, but there's been no mention either way, which I guess is why people are speculating, which is like, there are a couple of good series within Warhammer Plus. So will that therefore be made available to Amazon Prime customers? What will the nature of that commercial relationship look like, etc., etc.? So we'll see how that shakes out over time. I have no news, it's all speculation. So again, I'll share that as soon as I have anything more concrete. And I'd also just add that Henry Cavill continues to be just one of the best ambassadors you could really hope for. Speaking really positively, speaking about, like respecting the IP that we all love. I didn't mention last time, actually, and I should have done, but the other positive thing from a lot of the fans is that the creative director for Games Workshop is heavily involved in this as well. He's considered really knowledgeable about the lore, which is expansive and very wide. And there's also sort of been mentioned that, Cavill will be reaching out to sort of respected individuals within the community, sort of experts on lore, and kind of talking to them about that, which again, I think will make the fans happy, because, they will have felt in the past that they've been sort of given a rough time by Games Workshop, not unfairly at all, in my opinion. And so all of this stuff is just considered really positive. And I would say has been well received. Like when I look at Warhammer channels, I'd especially call out Lutin09, who I would say is like the lore expert on YouTube. His videos are amazing. He did a reflection of this and was broadly positive. He had similar concerns that everyone else has raised, but they were just positive overall. And likewise, I mean, you would struggle to find a better ambassador than Henry Cavill, who is a legitimate and bona fide fan. So I just wanted to flag that as well. That continues to progress from that perspective. Anyway, that's all the updates I have for now. We'll see how 2023 goes. I actually expect 2023 to still continue to be challenging before things improve. But again, my strategy remains unchanged. We will just be continuing to add into our positions, fill up some gaps in our portfolio, and basically holding our companies unless, of course, the IRS makes a tax change and I'm forced to sell it. But otherwise, I will be keeping my positions and bringing you updates, hopefully on a weekly basis. So thank you very much, everyone, for watching during 2022. Good luck for 2023. I've been the Boss Hog. Bye for now.